Moody's sits at the center of global credit markets. Governments, corporations, and investors rely on its ratings to determine how risky trillions of dollars in debt really are. It's one of the most influential businesses in finance and one of the most profitable. But the real question is, at today's valuation, are investors paying for quality or overpaying for past performance? I'm Khalstian, founder of EKH Capital, where we look for market-beating stocks for the long run. Today we're breaking down Moody's using our 5 key factors: economic moat, returns on capital, growth, financial strength, and valuation. Now let's start with the moat. Moody's operates in a regulatory duopoly in credit ratings alongside S&P Global. Barriers to entry are enormous: regulatory approval, decades of reputation, institutional trust, and embedded issuer relationships. You cannot simply launch a new credit rating agency and compete at scale. Beyond ratings, Moody's has built a powerful analytics and risk platform. Its subscription-based risk tools are deeply integrated into institutional workflows. Once banks and asset managers embed Moody's models into their systems, switching becomes disruptive and expensive. Compared to S&P Global, Moody's is more concentrated in credit and risk analytics, and S&P Global has broader exposure through indices and ETFs. So Moody's moat is slightly narrower in breadth, but arguably deeper in credit markets. Now, before diving into the numbers, this is where the story needs to be backed up by data. To break down Moody's return, growth, financial strength, and valuation, I'm using Fiscal AI, the research platform I personally use. If you want to follow along with the same charts and peer comparisons, the link below includes a 15% discount at no extra cost to you. A strong moat only matters if it translates into real returns. On a standalone basis, Moody's has a return on invested capital of 22.7% and return on equity of 62.1%. These are elite numbers. However, there's an important nuance. Return on equity is elevated partly because Moody's has aggressively repurchased shares over time. Buybacks reduce equity and mechanically increase return on equity. So while 62.1% looks extraordinary, investors should understand the stock buyback effect when comparing companies. Now, compared to peers, for return on invested capital, S&P Global sits at 8.7%, MSCI at 29.7%, and FactSet at 17.8%. Moody's sits near the top, trailing only MSCI. For return on equity, S&P Global is at 13.1%, FactSet 29.1%, and MSCI at minus 66.9%, distorted by aggressive share buybacks. Moody's clearly delivers top-tier capital efficiency. Now let's see whether these solid returns translate into actual growth. Over the last 10 years, revenue grew at a compounded annual growth rate of 8.8%, net income grew at a CAGR of 27.5%, and earnings per share grew at a CAGR of 29.2%. Revenue has grown at high single digits, but net income and earnings per share have compounded close to 30%. That combination comes from operating leverage and disciplined share buybacks. Now, compared to peers, earnings per share growth exceeds S&P Global and FactSet. This is the kind of profile long-term investors look for. High returns, recurring revenue, and consistent compounding. But strong past growth doesn't automatically guarantee future returns. Strong growth is only sustainable with healthy financials to back it up. Total cash and cash equivalents sits at $2.4 billion, total debt at $7.4 billion, and free cash flow at $2.6 billion, which gives a free cash flow to total debt ratio of 35%, meaning that Moody's could pay off its debt in 3 years. Debt to equity is at 1.7 and has been decreasing in recent years, so leverage exists, but it's manageable. Moody's generates enough recurring free cash flow to fund buybacks, invest in analytics, make acquisitions, and maintain financial flexibility. This isn't a fragile balance sheet, it's a capital-efficient one. Even the greatest companies can be poor investments when investors overpay. So how is Moody's valued today? Moody's trades at a forward price-to-earnings ratio of 28.7. Compared to peers, MSCI is at 29.4, S&P Global at 22.5 and FactSet at 12.2. Moody's trades near MSCI, the premium compounder in the group. Now let's adjust for growth. For the forward PEG ratio, we will use the long-term analyst earnings growth forecast, which is 12.9%. This gives us a forward PEG of 2.2. That's not cheap. Now let's compare that with the trailing PEG ratio. The trailing PEG is 1.2 based on historical earnings per share growth of 29.2%. Historically, growth justified the premium multiple. Today, the valuation assumes that strong growth continues. If growth slows, multiple compression becomes the risk. So this isn't a classic value opportunity. It's a quality at a price decision. Let's wrap up across the 5 key factors. Moody's moat is strong, built on credit ratings and deeply embedded risk analytics. Returns are elite, 22.7% return on invested capital and 62.1% return on equity, though buybacks inflate return on equity. Growth has been impressive over the last decade. Revenue grew at a CAGR of 8.8% and earnings per share at 29.2%. Financial strength is solid with enough free cash flow to cover debt. Valuation is premium at 28.7 times forward earnings and a PEG ratio of 2.2. Moody's is a high-quality financial infrastructure company. So the real question is, are you buying a compounding machine or overpaying for past performance?